Hey guys, this is Chris Mancola with the Mancola Group over at West USA Realty. Hope you guys are doing well. Just wanted to do our weekly market update for the greater Phoenix area and what's going on overall in the housing market. So I'm going to go ahead and start by sharing my screen here and jump right in, try and get through this really with you really quick and show you what's going on. So mortgage rates, this is from Mortgage Daily News, mortgage rates inched down to the lowest level since early February. And I got to tell you, it's definitely made a big difference in the foot traffic that we're seeing on paper and anecdotally. A lot of extra, properties under contract right now. We're starting to see, some multiple offer situations. And again, it's just that time of year. But then with the interest rates, it helps because spring season, when school lets out, all that is always going to be the biggest time of year. So right now, we're seeing rates. They're always taking the averages. So the averages here that they're showing was about 6.38. Again, it changes by the day, by the hour, and the week, and all that, and what's going on in the market. But this is kind of right along the same lines of what we've been telling you is going to happen, what always happens. Here is another article talking about this. From Mortgage Watch, mortgage rates dip amid economic uncertainty, which always happens once, we see we're in a bad economy, which, heading right into recession, but usually housing comes on top. And again, the undisputed champ, as I've talked about before in some of our newsletters and our other videos I put out about a week ago, it's 73, 7, and 1. And those times where it was either flat or, had a drop was during that 2007 to 2011 period where we had the crash. And that particular recession was due to the housing market. And again, it had to do with, crashing, and it had to do with over inventory, overbuilding, especially of new inventory. And then we saw the idea that, we got to unload these properties. So the builders, banks, lending institutions, we'll come up with all these fancy, fangled, lending ideas, and they didn't pan out. And people were buying homes that shouldn't have been buying homes or been qualified to buy homes or had any business buying even one home, let alone 3 homes. And again, you can always watch The Big Short if you kind of want to see how that all took place. But this is what we've been telling you is once we go into bad economy, yes, it's terrible. People are going to, lose their jobs. Inflation is tough. It has been tough. It's not been transitory like Janet Yellen and the Fed had tried to tell us it was going to be, just like we had mentioned many times in the past. And a lot of this just has to do with, yes, COVID, the extra printing of money was a big thing. There's a lot of money still sitting out there that hopefully they get their arms around. Maybe they can allocate it to better use and kind of put that back in where it should be in the economy. But, we had this thing ever since Alan Greenspan where we try to just print our way and spend our way out of financial, issues. And rather than just letting the market run the way capitalism is supposed to be, not crony capitalism where you're bailing out, too big to fail and all that. But because when you hear the full faith and credit of, the United States is going to, we have to pay our debt, are there really certain things that we have to really worry about? Maybe there's some grants we don't have to worry about, maybe overseas. Won't go any further than that. Maybe there's certain things we don't have to worry about, maybe spending that money on anymore, that money was printed for. Okay. And perhaps we can stop the crazy spending that started under Alan Greenspan to now, where we have this modern monetary theory where you just print money and spend your way out of it. And basically that's the biggest thing, is creating this crazy amount of inflation that we've seen. Now, we're telling you year over year inflation is coming down. And the biggest part of that is 43% of the core inflation that we see coming out of all these numbers is the lagging effect in shelter costs. So that'll start catching up in about 2 months, right around May 10th. We've been telling you about that date, May 10th. And due to the fact that it's such a big chunk and that we've seen a huge dip in that shelter costs. Okay. Um, we're going to start seeing the inflation numbers look better by May. Again, it's not to say that it doesn't cost a lot when you go to the grocery store or to buy gas. Some of that also has to do with some, lag in getting, uh, permits and leases for oil and all that. And I just saw a thing from Ford. I should have pulled it up here, but Ford CEO was talking about how we really can't do electric cars in a real way unless we're basically making the batteries here and we've got our own materials here, like the rare earth minerals and all those sorts of things. And then, there's been several articles put out now about, a lithium mine's really good for the environment. And then the whole idea of what do you do with these giant batteries, which are basically the size of the car after, they're put out. So, and to run our electrical grid, that's a whole nother thing, and increasing that by 30-40% and shoring that up, which is basically run off diesel fuel and things like that. So all of these overall policies and some of these ideas sound good, but when you start drilling down on them, just like with the banking sector, and these tech startups that really couldn't fund themselves, and now we're supposed to bail them out, and full faith and credit of the United States, but the full faith and credit of the United States is actually on you, right? Because you're going to pay more in inflation when any kind of credit or any kind of bailout or any kind of extra money is printed. You're going to pay that in either extra taxes or the most cruel tax of inflation. Those are just the bottom lines, guys. It's just how the economy works. But how does that affect our housing market? Well, it's like Lawrence Yellen, NAR, National Association of Realtors chief economist, talks about in this article how three recent bank failures. And by the way, guys, we're probably going to see more. So issues with Swiss Bank and German banks and all the different banks out there. I'm not going to go drill down into the details of all the banks, but we could see up to 180. They're talking about possibly 180 different banks having issues. And, the unfortunate thing is, when we have these smaller local banks, which we want, credit unions and local banks, because those are great for just anybody, but especially for small business owners who are the ones that really drive the economy and hiring and things like that. And as we, go along here with this stuff, we may see that some of them get eaten up by these bigger banks. So we'll keep an eye on it. But what is the benefit, or what's, kind of what we've been talking about is when we go into recession, we go into these issues, economic problems, it basically will lower the mortgage rate. And that's exactly what Lawrence Yun saying here in this article here. He says, meanwhile, just to kind of sum it up, meanwhile, the bank failures may be a sign of trouble ahead for the tech industry. Yeah, we may see some people lose their jobs. It could be 1 or 2 million people lose their jobs, but some businesses reliant on funding from Silicon Valley and others may lack capital to continue its business or have to cut back. And I explained this before, a lot of this has to do with the fact that, they're really, really the Fed raising the interest rates the way they did the Fed's fund rate, which indirectly affects mortgage rates, but it's basically the Fed's fund rate. So what it costs to get credit, what it costs to, in the end, to maybe sell some of these treasuries and stuff and make the money the way they do, and to servicers and everything. We were at like zero, for the up until about a year and a half ago. We were up, around zero. And then the Fed started raising the rates. Now we're up near 5%. They just raised it another 0.25%. We may see one more 25 basis point hike. Like this week, we had 25 basis point hike. And then I think they're going to stop because they're going to realize, again, you got to remember, people like Powell and Yellen, they're very academic. They've never really been in business, never really owned a business, very academic. So there, a lot of the stuff that they look at and their indicators and stuff are lagging. Some of the stuff is even computer generated through a lot of these companies that, forecast things in the media. So don't really look at things a lot of times in depth or drill down like into these shelter costs, into the fact that historically we hit recessions, and we look at we look at what really the unemployment rate was. They had this ridiculous unemployment numbers that came out, which is a big indicator for inflation and rates and all that. And they kind of rolled in seasonal stuff. Okay. I put this in a few videos that we did leading up to this week. And I even included some from Barry Habib talking about this. I'm going to have some more clips coming up, him talking about what's going on. But none of this changes the fact that we're going to see housing, and things. That's why people right now are looking at things like housing, and getting ahead of the curve, getting a good deal on a house now, maybe doing a buy down program to get a lower interest rate as the interest rates drop gradually, and then eventually you refinance no out-of-pocket costs into the lower fixed rate. But they're getting ahead of this stuff. People are going out and buying gold. I mean, even countries right now are, buying up as much land and real estate and gold as they can, because these are the solid things they can invest in versus the shakiness right now in the stock market. So those kind of things are going to be there. But he kind of goes into there could be some job losses ahead as a result among especially some California tech companies. He adds local housing markets may be hampered by those job losses, but okay, we've been talking about this forever, but broadly across the country, Yun says more home buyers will enter the market because of lower mortgage rates. You may lose people in these sectors, okay, these tech sectors, these tech startups, but or the over hiring that they did during COVID that isn't really needed right anymore as much as it was before. But when it comes to the lower interest rate, it's going to be double or triple the number of people who can now afford to buy a home or the home they wanted to buy, okay, or sell and buy, versus those who are out of the housing market, and maybe those in specific small little niche type jobs like these or parts of the country. Okay, so anyway, moving on from that's right in line with what we've been talking about. And then buying and selling, spring season coming up. We've got the idea that people want to move when school lets out. Typically that's normal, unless you're a more seasonal area. But the biggest thing to know is you're going to have more competition in the spring than you would any other time of the year. There may be a little bit more inventory, yes, but there's also more competition. So it's usually the time of year that we see housing prices go up the most also. And then when you couple that with the fact that by May 10th, we're already seeing it, but by May 10th, with all these economic issues, but by May 10th, year over year, inflation numbers are going to be much different. And you throw in the shelter costs, which are always lagging several months to up to a year. By May, we're going to see the difference in those inflation numbers, because again, 43% of that is made up by shelter costs. Okay. The other big thing is, again, I mentioned earlier, we had the 2008 crash. We had over inventory. We had in the greater Phoenix area, for instance, we had 56 up to 58,000 homes for sale at any given time. Right now we've got 14,000. That's been holding pretty steady around that number, give or take a little bit, for the last couple of months. Nowhere near those type of numbers for all active properties for sale. Keep in mind, builders are not getting as many permits due to the uncertainty in the markets right now. They kind of slowed their building time because they learned from the other crash in 2008. So they're not going to overbuild again. Okay. So inventory is a big thing that kind of has been keeping things stable as far as pricing is concerned. Okay. And we talked about this the last couple of weeks, in the last month or so, we've seen under contracts going up, skyrocketing, especially in the Phoenix area, and a lot of parts of the country, but especially in the Phoenix area. And we've been seeing that the prices have been going up, properties going under contract, a lot more foot traffic. So jumping right into the CMI, the Cromford Market Index, this is something that we like to look at every week. Cromford, they're linked in right with our local multiple listing service, and between 90 and 110 on their market index, that's the balanced range. Okay, 100 being dead center in that range. Anything over 110 is going to be a seller's market. Anything below 90 is going to be a buyer's market. Okay, so right now we're right at, let's see, on the index, we're at 134.3. Looking down here at the bottom of this chart, we are at 134.3. Okay, so that's up another couple of points or another point or two from last week. Our demand is at 83.2. So being at dead center at 100, that's below, that's about 17 points below, 16.8 points below, and then supply is at 62.4. Okay, and again, 14,000 homes right now for sale, a little over 14,000. To be in a real true balanced market for inventory right now with the demand that we're seeing, we would need to be right around 30,000 homes on the market, right? Pretty, give or take a little bit, right around 30,000. So just to kind of give you an overall idea on the market, that's where we're at right now. Looking at some of these numbers, some of the things I wanted to point out was we're actually seeing, more sales per month versus last month, the same time. Sales per year are down a little bit, but just a hair. Okay, see those two numbers right there, 81 to 78. Days on market is 78. Okay, days on market sales, I'm sorry. Days on market active, okay, 92. And then we've got month supply at 2.1. That's pretty brisk market. Right now, the contract ratio is, let's see, from Cromford, the contract ratio is at 64. Okay, 64. So anything over 60, according to them, is a hot market. So we're definitely well in a hot market. That's been gradually going up since let's see, beginning of the year. Okay, so that's a good indicator of where we are in the market. Again, nothing crazy, because again, with the market index right now is 134, a little over 134. When we were in a crazy anomaly market for sellers, okay, so it's a slight advantage of sellers, it's over 110, but crazy anomaly market we were in, it was well over 400, almost 500. It was like 480 something at the height of last year, early Q1, Q2 last year. So right now, looking at the cities individually, if we look at those individually, let me just pull this out. Okay. Chandler's at the top of the charts on the Crawford Market Index. Chandler is number one. It's up 26% from last month, and it's at 213.8 on that market index. So well within a seller's market. After that, it's 186 with Fountain Hills, and then Glendale at 173. Glendale, 173. Phoenix is at 170 on the index. So again, well into the seller's market. Gilbert, 162. Avondale is 159. Mesa, 152. Cave Creek, 140. Scottsdale at 135. And Peoria is 133. Tempe, 128. Paradise Valley is at 117. Now, Tempe and Paradise Valley did drop. Tempe 8%, 14% down on Paradise Valley. Overall, we're seeing, let's see, we are see a 12% increase from I'm sorry, 11% increase overall for the CMI and these cities overall. And last week it was 12%. So a little bit of a deceleration there, but still overall on the upswing. And again, the lower rates that we've seen, in a while, those are helping the season time of the year. The overall though, we're seeing that all these are heading into a seller's market, except trending towards seller market, except Tempe and Paradise Valley. Even though they're in a seller's market, they just trended down this past week. Surprises at Goodyear at 101. Even though those are up on the index, they are in a balanced range. Okay. They're below that 110, between 90 and 110. And then Queen Creek, Maricopa, and Buckeye are all in buyers markets. Okay. Buyers markets. Okay. So, sales per month has had a big upswing at 65, let's see, 6,500. Oh, and there was, let's see, let me just pull this back up real fast here. I wanted to see something. Our average sales price from last month is, let's see, we're at 540 for the average price monthly sales price, 540, just over 540. And last month it was 520. Okay. So, huge. And our listing success rate from last month was 73 last month. We're at 78 now. So, listing success rate. So that's a huge change that we're seeing again, going into this, swing on into a seller, more of a seller's market, but not crazy, which I'll talk about here in a second. So these are good numbers. These are healthy numbers, a little over 2 months supply. That's a brisk market. Then we've got, let's see, closings over list price by price range the last 30 days. We're seeing an increase in pretty much every segment of that number. Okay. Or from every price range that we look at in our market here in the Phoenix area. But the biggest price range would be, let's see, 250 to 300,000. That's the biggest increase at 22.2%. The largest market, the largest closings over list price is $300,000 to $400,000 range. But the one with the biggest increase is 250 to 300. Okay. But all of them except for 2.5 to 3 million, that's at 0% increase overall. But closings over list price. So we're seeing a lot of closings over list price happening. And that number seems to be growing along with that contract ratio, like I talked about. So, again, things are really heating up. Let's see, sales rate is, let's see, year over year is down 25%. Okay. But in the fall, okay, these are year over year. In the fall of 2022, we were down 45%. So that number has increased 20% to the good. Okay. And then iBuyers, here's some other interesting numbers for you. iBuyers year over year, okay, they're down 95% on purchases. Okay. Purchases, they're down 95%. So iBuyers like Open Door, OfferPad, those sorts of things. The let's see, they've been selling more, okay, but they haven't been purchasing much. Institutional buyers, more institutional type of buyers or investors, they're down 69% year over year. And we see flips are also down 50% year over year. The average list under contract price, is $300.45. So that's price per square foot. Okay. Average list under contract price, that's price per square foot, 300. Last year it was 297.80. Okay. 297.80. That's price per square foot. March of 2023, we have, let's see, 16% sales over list. Okay. 16% of sales over list, and 47% of sellers are paying some sort of a seller concession. So one thing to note there is, this is interesting because right now the big thing is buyers want to try and get, and we always try this for our buyers, we recommend it. Sometimes it doesn't make a lot of sense at first, but to get the seller to pay closing costs, more importantly, more specifically, to buy down your rate, or even better, buy down your rate into a buy down program. Okay. So there's 3-2-1 buy downs, 2-1 buy downs. Again, these numbers fluctuate, but I've seen them as low as 2 and 3% the first year. May go up a percentage point from there each year for 2 or 3 years, whatever the case may be. But the idea is that again, by May, June, July of this year, we should specifically see mortgage interest rates dropping due to those shelter costs, due to the year-over-year core inflation and CPI coming down overall. And that's when we see these sorts of numbers shift. Inflation drives mortgage rates, not the Federal Reserve. Okay. So the, inflation goes up, rates go up, mortgage rates go up. Inflation comes down, shelter costs come down, which is 43% of the core inflation. Interest rates come down. Okay. So that's why we keep pushing this idea and, and understanding these data points and what happens over history, even in recessions, except for the housing recession of 2008 and that period of, 2007 to 2011, where we saw, that happened. But, overall housing for 81 years has been 73, 7, and 1. Okay. And the only time it's been flat or down or over those, over that period of time of that 2007 through 2011. So guys, if you have any other questions, would like me to bring up anything else, these are some good points that you guys have actually get some input in that I wanted to get out there on the iBuyers and investors and stuff. Let me know. I'd love to be able to talk to you about it more. And, highly recommend, if you have any interest in buying or selling a home, I'm happy to talk to anybody. We've also got preferred lender and our people over at Modern Home Lending that can help you through understanding, getting a home loan pre-approval, a refinance, cash out refi. Right now, HELOCs, home equity line of credit, is really something that people are looking at with uncertainty, maybe in their economic situation, for emergencies to have there, which may make more sense sometimes right now with the higher rates than a cash out refi. So it's called a HELOC, or home equity line of credit. That's something to look at. Also reverse mortgages. There's all kinds of stuff out there. So if you guys have any questions at all, feel free to reach out. It's 480-788-8569, or you can check us out at MancolaHomes.com, MancolaGroup.com. And you can always email us at home@MancolaGroup.com. I'll be putting out some more video clips, 1 or 2 at least, from Barry Habib here in the next day or two, along with some other shorts. So if you always want to check out the latest on our videos and tips and tricks and what's going on in the market and all that, best thing to do is go to Mancola Group on YouTube. Check us out. We'll have all the links here below or in the weekly emails, and we'll make sure we put it on social media. All right, guys, you can check us out there. And of course, always check us out Facebook and Instagram too. Talk to you next time.